So now let's revise the second chapter. So the second chapter that we're going to revise is called leverages. Now, first of all, before we get into this, before we get into the revision of this particular chapter, first understand what do you mean by a leverage? What do you mean by a leverage? Leverage means getting more results by putting lesser efforts. This is the meaning of leverage. Common layman word. The meaning is getting more results by putting less efforts. So something like chinna kallu pedda labam, right? So small efforts but more more results. That is the meaning of leverage. So can you give us an example? Yes, I can give you two examples. Example number one. Now let us say you are 60 kgs of weight. Okay, let us say you are 60 kgs of weight. Now your friend is also approximately 60 kgs of weight. Let us assume. Now if you want to lift your friend just like that, it will be very difficult. I'm not saying it is impossible. It will be very difficult. But even if you lift him, maybe in a span of next 5 seconds, you'll just drop him back. Correct? You'll have to put a lot of efforts in lifting him. It's very difficult basically to lift another human being who is of the same weight as that you are. Am I right? But now, if you see, recall your childhood days where we used to play something called as seesaw. Yeah, you know the seesaw? So it will be like this, and two people will sit here. So one person will be sitting on one side, the other person will be sitting on other side. Have you ever wondered if, let us assume, both these people are of the same weight, 60 kgs, just an example. Now, if I want to directly lift him, I find it very difficult. But if I use the seesaw, if I put my weight here, automatically the other guy is being lifted. Yes or no? And how is this possible? The same human being, without a seesaw, I'm finding it difficult to lift him. But with a seesaw, I just have to put little efforts, but I will get the same result. Are you clear with this? Why? Because this seesaw acts as a lever. And this is what is the meaning of leverage, and hence the name leverage. Why? Because if you have this here, the seesaw has something here in between, right? And you have some nails and all inside it. Fine. So this, if this guy goes down, this guy goes up, and vice versa. If he goes down, this guy goes up. Yes, but this is called as leverage. That is more results by putting lesser efforts, more like a smart working. This is why I said chinna kallu pedda labam, right? Something of that sort. Are you clear with this? That is the meaning of leverage. Sir, how is this related to financial management? I will connect the dots. You don't worry about it. But for the time being, you just follow whatever I'm saying. So basically, what do you mean by leverage? Lesser effort and more result. So your effort should be less, and for the lesser effort, you will get more result. Are you clear with this? One more example. Now, have you seen a well? A well, as in, it has water in it, that well. Okay, so typically now we don't have wells in cities, but yes, in rural areas there are still wells, right? Now if you see here in this well, okay, so a person can lift water from this well directly. He can tie a rope, yes, put a bucket, automatically he can just throw it inside, take the water, yes, he can pull. But still, have you wondered why they are using this something called as pulley? Yes, have you seen this pulley? So the thread will be, the rope will be tied to this, and from this they will actually hang this particular bucket. But why do they do that? Because now if you have this lever or if you have this pulley, it is easy for you to draw the water from the well. Are you clear with this? In this case, this acts as a lever. Less efforts and more results. Are you clear with this? So basically, leverage stands for, this is the meaning of leverage. Leverage means getting more results by putting lesser efforts. Are you clear with this? Now, how it is concerned with financial management, I'm coming to it. Fine. Are you clear? First, know the reason, know the logic, and know the conceptual background for every chapter, which is very important. Right. So we saw what is the meaning of leverage. Right. This is one thing. Park it aside. Now, one more thing I want to tell you. One more thing before we enter into this chapter. One more thing I want to tell you. Now, in a company, basically in any organization, fixed cost is of two types. Don't worry, I will connect all these things. First, understand a few things, and then I will connect all the dots. You need not have to worry. Fixed cost can be broadly classified into two: fixed operating cost and fixed financial cost. Sir, what is the meaning? First of all, what do you mean by fixed cost? A cost that remains constant in total. So it will not change with your change in volume. Basically, you would have learned this in your costing. For those who have not studied costing, fine. Fixed cost means this. Common sense, it will not change no matter what. No matter what, if there is a change in sales, if you increase your volume or decrease your volume, this cost will not change. It will remain as such. Now, fixed cost, sir, you are classifying this into two: fixed operating cost, fixed financial cost. Fixed operating cost, example, if you want, fixed operating cost, in costing, you would have studied production overheads, administration overheads, selling and distribution overheads, correct? So examples for this could be salary, rent. See, salary, your rent, etc. Salary, if it is paid for factory, it comes under POH, production overheads. If the salary is paid for administrative office, it is called as AOH. If the salary is paid for a sales staff, it is called as selling and distribution overhead. So broadly, POH, AOH and SOH. This is what comprises of your fixed operating cost, or in other words, the fixed costs that are related to my operations is called as fixed operating cost. All the fixed costs that you have studied in your costing paper is called as fixed operating cost. So, fixed financial cost means what? The fixed costs that are associated with the fundraising activity, associated with your sources of finance, is called as fixed financial cost. What is it, sir? The first one is interest on debentures or term loans, and the second one is dividend on preference shares. These two are the fixed financial cost. And remember, in costing, any financial cost is not at all considered for the purpose of arriving at the profit. Are you clear with this? Whereas all these finance related costs are considered only in this subject called as financial management. Are you clear with this? So fixed cost can be broadly classified into fixed operating cost, fixed financial cost. Fixed operating cost means what? Any fixed cost that is incurred for your operations, broadly your production overheads, admin overheads and selling overheads. And here fixed financial cost means what? The financial cost that is the fixed cost that is associated with your fundraising activity, source of finance, broadly your interest on debentures and term loan and your dividend on preference shares. Are you clear with this? Yes. These two are what? These two are the fixed financial cost. Sir, dividend on equity shares, it is not a fixed financial cost. We just saw right now. Dividend, equity dividend, is there is no contractual obligation for the company to pay every year. Correct? There is no contractual obligation. 1 year, if they want, they can pay. If they don't want, they cannot pay. Whereas fixed cost doesn't have that option. No matter what, you need to pay. So like that, there are only two. Broadly, there are only two fixed financial costs: interest on any of your borrowings, that is debentures or term loan, and dividend on preference shares. Are you clear with this? Yes. Now, with this backdrop, let us get into the profitability statement. Don't worry, I will connect all the dots. You need not have to worry, I will connect all the dots. Fine, even if you're watching this for the first time, you need not have to worry, I will connect the dots. First, I went on to say, what do you mean by leverage? Then I went on to say, classify fixed cost into fixed operating and fixed financial cost. And now we are seeing profitability statement. Trust me, I will link everything and then we will properly enter into this chapter. We will revise this chapter very quickly and in a very logical manner. Now, look at this. So this is your profitability statement. You ignore all these things. I'm here to explain this. First, let us look at profitability statement. So how will your profitability statement look like? Sales, that is the topmost, the first line item, sales less variable cost gives you contribution. What do you mean by variable cost? A cost that varies with my production. Example for this is going to be direct material, direct labor, direct expenses and all. Technically, all these are a subject matter of discussion in costing. Clear? Sales minus variable cost gives you what? Contribution. Nothing but sales minus variable cost gives you variable profit. And variable profit is only called as what? Contribution. Correct? Is this the final profit? No. Why? Because fixed cost is yet to be adjusted. Are you clear with this? Sales minus variable cost gives you contribution. Contribution minus fixed cost. Here, fixed cost means what? Fixed operating cost, that is AOH, POH, SOH. I just told you, right? So contribution minus fixed operating cost gives you what? Operating profit, correct? Operating profit, or in other words, EBIT. So technically, your costing subject stops here at EBIT level. Are you clear with this? There, in costing, the subject matter of studies, sales minus variable cost gives you contribution minus fixed operating cost. Finance cost is not considered. Fixed operating cost gives you EBIT, or operating profit, is popularly known as earnings before interest and tax. Are you clear with this? Now, FM begins from here only. EBIT means what? Earnings before interest and tax. So first reduce interest, minus interest gives you what? Earnings before tax. Yes. Now minus tax gives you what? Earnings after tax. Correct. You can also call this as EAT, PAT or EAT. Anything is fine. Correct. Earnings after tax. Now from earnings after tax, you reduce preference dividend. You get what? Net earnings available to equity shareholders. Are you clear with this? Yes. So this amount, this is the amount available to whom? Available to the equity shareholders of the company. Yes, if you divide this by the total number of equity shares, you will get something called as EPS, meaning what? Earnings per share. Are you clear with this? First of all, understand this profitability statement. You should know this by heart, and there is nothing to mug. There is nothing to mug it up. Basically, you can learn this conceptually. So what is your profitability statement? Sales minus variable cost gives you contribution, minus fixed operating cost gives you what? Gives you EBIT, operating profit. Actually, costing stops here and FM begins. EBIT minus interest gives you what? EBT, earnings before. EBIT minus interest gives you EBT, earnings before tax. Minus tax gives you what? Earnings after tax, EAT. Then minus preference dividend gives you net profit available to equity shareholders. This divided by number of equity shares gives you EPS, that is earnings per share. Are you clear with this? This is the overall profitability statement. Are you clear with this? And if you see, fixed cost can be what? Fixed operating cost, or it can be what? It can be fixed financial cost. In this case, what is the fixed financial cost? Interest and preference dividend. These two put together is your fixed financial cost. Are you clear with this? Whereas this figure is your fixed operating cost. In this chapter, this fixed operating cost and fixed financial cost is the hero. Actually, it plays around the entire chapter. We are studying the concept of leverage itself. We are studying only because of the presence of fixed financial and fixed operating cost. I will explain more logic. Fine. So now, first understand, in this entire statement, you can find what? Fixed operating cost here. Then less interest and preference dividend. Interest and preference dividend put together is what? Fixed financial cost. Now, one more doubt you might have. I have seen students getting this doubt. Sir, now in your operating fixed cost, you have considered your production overheads, administration overheads, selling overheads. Perfect, sir. In your fixed financial cost, you are considering interest and preference dividend. Perfect. Now, sir, there is one more line item called tax. Correct? Tax is also an expense only, no, sir? Yes, yes. Now, this tax, you tell me, this, why are we not clubbing it under fixed financial cost? Now, first of all, understand. Tax is a non-operating item. Are you clear with this? So, it is definitely not a part of your fixed operating cost. Are you clear with this? Yes, it is definitely not a part of your fixed operating cost. Now, what do you mean by finance related cost? Any cost that is paid towards fundraising activity, that is to the people who have given you finance. If you are paying them something in return, that is only called as what? Financial cost. Correct? For example, interest, it is paid for what? It is paid to debenture holders. Why do you pay? Just like that you pay? No, they have given you some debenture money, capital they have given you, for that you are paying something called as interest. Preference dividend, why do you pay? Because you have raised the money through the preference channel. Now you tell me, tax is not related to finance, or in other words, tax is not a finance related cost. It is not an expense that is incurred for raising any finance. It is the law of the land that says that if you earn some profit, you pay some tax. As simple as that. So tax, if you see, it is not a fixed amount. It is actually a percentage on my EBT, earnings before tax. Are you clear with this? So then you can call it as a variable cost. No, it is not variable. Variable means what? It should move in proportion with your sales. Your tax will not move in proportion with your sales. It moves in proportion with your EBT, earnings before tax. Are you clear with this? So technically, tax is neither a variable nor a fixed. Sir, why, sir? Why are you saying like this? Tax I need to pay to the government. Suppose you have zero profit. EBT is zero. Let us assume. Will you pay any tax? No. Correct? Then how can you call it a fixed cost? Correct? If you have an EBT of 100 crores, let's say the tax rate is 30%, then 30 crores will be your tax amount, correct? But this 30 crores will not move in proportion to the sales. It moves in proportion only with your EBT. So first understand that this tax is a separate line item. This is a separate animal altogether. So don't worry much about it. This is not a finance related cost, correct? This is also not an operating related cost. Are you clear with this? Then, sir, why did we consider your tax component while computing KD and all in the cost of capital chapter? That we did to compute the cash flows, correct? If I pay interest, there is a tax deduction practically. So for the purpose of computing the tax savings, we did. Are you clear with this? But this is technically, this cannot be classified as a fixed cost and all. Are you clear with this? This is what I want to tell you. Right. Now, sir, so you mean to say basically this particular profitability statement, sales minus variable cost gives you contribution minus fixed operating cost gives you EBIT minus interest, EBT minus your minus tax gives you EAT, minus preference dividend gives you your net profit available to equity shareholders divided by number of equity shares gives you what? Your EPS, means what? Earnings per share. Simple. Now, sir, more the EPS means more the earnings. Is it true or not? More EPS means the company is earning more. Is it true or not? Absolutely not. I will give you an example. Let's say there are two companies, A Limited and B Limited, right? Let's say the earnings available to equity shareholders, for A Limited, let us say is 100 crores. For B Limited, let us say there is only 10 crores. Now, you will say, sir, A Limited is performing better, sir. Why? Because they are earning 100 crore rupees. B Limited is only making 10 crore rupees. But wait, let's say the number of equity shares, let's say the number of equity shares in case of A Limited, there is 100 crore equity shares. Whereas in case of B Limited, there is only 1 crore equity shares. Now you tell me, earnings per share, every share will generate an earnings of how much? In case of A Limited, it will generate 1 rupee. Whereas in case of B Limited, it generates 10 rupees. So if you see, for B Limited, the EPS is more. Whereas in terms of total earnings, it is more for A Limited. So please don't jump to the conclusion saying that more earnings means more EPS. No. EPS is a function of earnings and the number of shares. So earnings and number of shares both will have to be considered to arrive at your EPS. So always remember, more earnings does not equal to more EPS. Have this in your mind because this is the general misconception that students have. I would any day prefer B Limited. Why? Because for every share that I am buying in this company, it earns 10 rupees. Whereas for A Limited, for every share, it generates only 1 rupee. Are you clear with this? So more earnings does not mean more EPS. So this is one important understanding that you need to have. Right. So now, sir, why are we studying all this in the concept of leverage? Now, let us get started. Now, in this chapter, there are 3 different types of leverages. Operating leverage, financial leverage, combined leverage. 3 leverages are there in this chapter. Are you clear with this? Yes. Now, what do you mean by operating leverage? It shows the relationship between sales and EBIT and it indicates business risk. Fine. Financial leverage. It shows the relationship between EBIT and EPS and indicates financial risk. Combined leverage. It shows the relationship between sales and EPS and indicates the total risk. Over. That's all. Chapter over. Right? Look. It is not just you read one line mug up. Absolutely not. This is filled with loads and loads of concepts. Now, let me just explain this concept to you. Now, this is where our I gave you what is the meaning of leverage. That is less efforts, more results. Correct? There, let us bring that into picture. First, let us start with operating leverage. Now, operating leverage is actually something that is concerned with your business risk. This has nothing to do with your financial items. It has something to do with your business risk. Or in other words, your operating leverage is calculated in your costing area. That is the first half of this profitability statement is where you calculate your operating leverage. Sir, What is the meaning of operating leverage? Wait, I will explain this to you by way of an example. See, these are very, very important in terms of understanding the concepts. These are very, very important. So you need not mug up any formulas. It is just a very, very logical area and you can automatically get all these formulas by yourself. Now, let me just take an example for this. The first one is what? Operating leverage. And what did they say? Operating leverage talks about the relationship between, one second, the relationship between what and what? Between sales and EBIT. Sir, what is this? I will give you a superb example here. Now, with this example, you will learn this entire concept of operating leverage. Now, let me just drop a tabular column, particulars, okay, and then 3 columns I'm drawing, okay, 3 columns. Let us call this as base. Let us call this as base. Please keep following this, or I will just call this as existing, okay, existing. Let's put it as base, not a problem. And let me put this as scenario 1 and let me call this as scenario 2. So what are you doing? Wait, let me just do this and then I will explain. Don't worry about it. Now, I'm giving you the following data. Sales, existing sales in terms of units. The current sales units, let us say, is 2000 units. Okay, let us say the current sales is 2000 units. Okay, in case 1, it is what? 1000 units. In case 2, it is 3000 units. I'm just giving an example, 3 scenarios, that is existing scenario, then scenario 1 and scenario 2. Just keep following this particular example. Now, selling price per unit, fine, it is rupees 10 in all the cases because selling price per unit will not change. Similarly, variable cost per unit, let's say it's going to be how much? 5 rupees. Okay, and let us say the fixed operating cost, is going to be how much? Let us say it's going to be 5,000. This also does not change with the scenario, correct? Always remember, variable cost remains constant on a per unit level, fixed cost remains constant in total level. So that's why variable cost is constant on a per unit level, even there is a change in volume, and even if there is a change in volume, fixed operating cost remains constant on a total level. Are you clear with this? These are some basic concepts. Now, let us prepare that first half of the income statement. Sir, what is the first half of the income statement? Sales minus variable cost gives you contribution minus fixed operating cost gives you EBIT, right? So let us prepare that. Now, sales minus variable cost gives you what? Contribution minus fixed operating cost gives you what? It gives you EBIT, or in other words, that's going to be your operating profit. Now, let's calculate this. Let's do this figures for each of the scenario. In scenario 1, what is the sales value? Simple, 2000 units into 10. How much is that going to be? 20,000 rupees, correct? It's going to be 20,000 rupees. Yes. What will be the variable cost? 5 rupees per unit into 2000. How much is that? 10,000 rupees, right? So what's the contribution? The contribution is going to be 10,000, right? What is the fixed operating cost? 5,000 rupees. So 10,000 minus 5,000, you get an overall operating profit, EBIT, of how much? It's going to be 5,000 rupees. Are you clear with this? Yes. Let's go to this situation 1. In situation 1, what they are saying, the total units sold is how much? 1,000 units. So the sales value is 1,000 into 10, that's going to be 10,000, right? Variable cost is 1,000 into 5, that's going to be 5,000. And your contribution is going to be 5,000 rupees. Fixed operating costs, how much is this? That's going to be 5,000. So now, what is this? What is your EBIT? EBIT is going to be 0 in this case, correct or not? Yes. Now, let us go to the scenario number 2. The sales is 3,000 units, okay? So what is the sales value? 3,000 into 10, 30,000. Variable cost, 3,000 into 5, that's going to be 15,000. The contribution gives is how much? 15,000 rupees minus the same 5,000. This gives you how much EBIT? This gives you how much EBIT? EBIT of 10,000 rupees. Now, just look back and observe this particular 3 situation. Now, what happens? What happens? Presently, when my sales is 20,000 rupees, how much profit am I earning? EBIT, how much am I earning? 5,000 rupees. Now you look at this very interesting observation. Very interesting observation. Look at this. If I increase my sales, to how much? 30,000. Or in other words, if I increase my sales by 10,000 rupees, or this 10,000 divided by 20,000, how much is this? If I increase my sales by 50 percentage, correct or not? Here from 20,000, the sales has gone to how much? 30,000 rupees. Or in other words, how much is the percentage change? The extra is 10,000. 10,000 upon base 20,000 is going to be how much? 50 percentage, correct or not? Yes. So if I increase my sales by 50 percentage, you just see what is happening to the profit. My profit increases from 5,000 rupees to how much? 10,000 rupees. Or in other words, my profit increases by how much? 5,000. 5,000 upon 5,000 is how much? 100 percentage. Are you clear with this? Are you clear with this? See what is happening here. If I increase my sales by 50%, my EBIT increases by 100%. Chinna kallu pedda labam. Small efforts, more benefits. Are you clear with this? This magnifying effect is only called as leverage. Guys, are you all clear with this? If I increase my sales by 50%, right, my profit will increase by 100%. But wait, don't think it is always good. Similarly, what happened here? If my sales falls by 50%, what will happen to your profit? From 20,000, it became 10,000. So 20 minus 10 is how much? 10,000 fall. 10,000 divided by 20,000 is 50%. If there is a fall in your sales by 50%, your entire profit from 5,000 becomes 0. Or in other words, what is the change in profit? 5,000 rupees. 5,000 upon 5,000, it's going to be 100. Or in other words, if your sales decreases by 50%, your profit will fall by 100%. So the magnifying effect will be working both in your favor as well as it can work against you. Are you clear with this? So if you increase your sales by just 50%, your profit will increase by 100%. But remember, if your sales even drops by 50%, your profit will fall by 100%. So with lesser effort, you are able to make more profit. But if there is a lesser fall in sale, then the fall in profit will also be huge. So it is called as a double-edged sword. It is positive as well as negative. It has both advantage as well as disadvantage. Why, sir? If you just increase your profit by 50%, sorry, if you just increase your sales by 50%, your profit will increase by 100%. But if your profit falls by just 50%, the fall in profit will also be 100%. So the profit falls by 100%. Are you clear with this? Or in other words, can I say there is a magnifying effect in this particular case? What is the magnifying effect? Can I say that operating leverage is nothing but percentage change in EBIT divided by percentage change in sales? Correct or not? In this case, can I say this is nothing but 100% divided by 50%? Are you clear with this? You can say plus 100% divided by plus 50%, or you can say minus 100% divided by minus 50%. Whatever it is, how much you get? 2 times. So can I say my operating leverage is 2 times? Meaning what? If I increase my sales by 50%, my profit will increase twice this. That is, my profit will increase by 100%. But remember, this is always not good for you. It is good as long as sales is working in your favor. But if there is a drop in sales even by 1%, then your drop in profit will be 2 times the drop in your sales. That is, your profit will drop by 2%. That's why here, if you see if the sales drop by 50%, your dip in your EBIT will be twice this 50%. That is, it will be 100%. Are you clear with this? And this is called as, the study of this is called as operating leverage. Are you clear with this? Now, sir, why is this operating leverage happening? That is this magnifying effect. Why is this happening, sir? Sir, if I increase my profit, if I increase my sales by 50%, why is my profit increasing by 100%? Correct. First, I hope you understood this. How we got this 50%? From 20, it is increased to how much? 30,000. So how much is the incremental sales? 10,000. 10,000 is the increase in sales divided by the base sales of 20,000. How much is that? 50%. Similarly, here if you see from 5,000 it has increased to 10,000. So how much is the incremental profit, extra profit? 5,000. So what is the change? 5,000 divided by the base 5,000, 100%. Are you clear with this? So if I increase my sales by 50%, my profit is EBIT is increasing by 100%. Sir, why is this happening? Why is this magnifying effect happening? This is happening purely because of the presence of fixed cost. Sir, can you prove this, sir? Absolutely. This is purely happening because of fixed cost. Now let us assume in the same example, assume the fixed cost is 0. Let us assume the fixed cost is 0. Are you clear with this? Let us assume the fixed cost is 0. Now what will happen? I'm just quickly doing this. Sales minus variable cost gives you contribution minus fixed cost is equal to EBIT. Correct? EBIT. Fine. Now three scenarios we saw. Correct? In the first scenario, it was how much? The sales was 20. I mean the existing scenario, scenario 1, scenario 2. Right? Fine. Now you tell me, in the first existing scenario, the sales is how much? 20,000. Variable cost is 10,000. Right? Your contribution is 10,000. Right? And the profit and the fixed cost in all the three cases, now let us take it as 0. So what will be your EBIT? Your EBIT will be 10,000. Correct or not? I'm just copy pasting the figures here. From here, I'm just copy pasting it. Just that now I'm taking fixed operating cost as 0. Now, in the scenario 1, what happens? My sales is how much? 10,000. Variable cost, 5,000. Contribution becomes 5,000. Fixed cost, let us say fixed cost is 0 here. What's my EBIT? My EBIT is going to be 5,000. Right? In situation 2, my sales is going to be 30,000. Yes. Variable cost is 15,000. Contribution is how much? 15,000. Fixed cost is 0. EBIT is how much? 15,000 rupees. Now you see here, if my sales increases by 50%, if my sales increases by 50%, how 50% we got here? So 30 minus 20, how much is it? 10,000. 10,000 upon 20,000 base is going to be how much? 50%. What happens to my profit? My profit is also increasing by only 50%. How we got this 50%? What is the increase in profit? From 10, it has become 15. So 5,000 divided by 10,000. How much is it? 50%. Suppose if I reduce my sales by 50%, if my sales falls by 50%, look at this. My EBIT also falls by 50%. From 10,000, it became 5,000. So what is the change in profit? It is reduced by 5,000. 5,000 upon 10,000 is 50%. Or in other words, in this case, you calculate your operating leverage and see operating leverage is what? Percentage change in EBIT divided by percentage change in what? Sales. In this case, it is going to be 50% divided by 50%, it is going to be 1. Or in other words, there is no magnifying efforts. Whatever effort I put, that is also being resulted in my actions, in my results. Are you clear? So my effort, whatever I put, it is getting in my action. So why this is happening? Then in the first scenario, why did we have this leverage or this particular magnifying effect? Purely because of the presence of what? Purely because of the presence of fixed cost. Are you clear with this? And that's why I said at the time we started, fixed cost is the hero of this particular chapter. So because you have fixed cost in between, what happens? Your EBIT is not moving in proportion to your sales, so it moves in a different proportion. That is, in this case, what happens? The sale value is increasing. So the contribution is also increasing, but you just need to, the fixed cost is not changing, it remains the same. So what happens? The profit that you make will entirely be the increase in the contribution, correct? See here, if you see from 10,000, my contribution increases to 15,000, correct? From here, if you see, this 5,000 profit will increase to 10,000, or in other words, this fixed cost does not change. It is the same fixed cost. So obviously here, since it is not moving in proportion, so beyond this point, what happens? There is a magnifying effect. And we learn this by way of what? By way of this particular example also. If you keep your fixed cost as 0, what will happen? There will not be any magnifying effect. Don't say your leverage will be 0. The leverage will be 1. That is the percentage change in EBIT divided by percentage change in sales will be what? 1 in this case. Are you clear with this? So to put it short, what do you mean by leverage? Leverage means common word leverage. Leverage means what? Leverage refers to putting lesser efforts, getting more results. Are you clear with this? Now, in case of operating leverage, it is a study of relationship between your sales and EBIT. So by how many times my EBIT will increase as compared to my increase in sale, or in other words, percentage change in EBIT divided by percentage change in sales. If I do, that is only called as operating leverage. Now, what is that to mug in this? Guys, are you clear with this? Are you clear with this? Yes. Now there is one more formula for operating leverage. First, let's just do this. So operating leverage is also known as degree of operating leverage. Both are one and the same. Don't think degree of, if they add these words, it is something else. It is exactly the same as operating leverage. Short form is DOL. So what is the formula? Percentage change in EBIT upon percentage change in sales. Alternatively, there is one more direct shortcut formula. Operating leverage is contribution divided by EBIT. Sir, what is the logic for this? This is a mathematically proven theorem. That is, if you want, I can definitely prove it. In my regular lectures, I just take little extra time and prove this formula also. But since we are in a marathon, I don't want to get into the technicalities of it. It's not, I wouldn't say it's not logical and all. But what I would suggest is, it has to be mathematically derived. The derivation will go for 1.5 pages. We will start from this percentage change in EBIT upon percentage change in sales. Very logical derivation. We will derive, and finally you will get this as contribution divided by EBIT. Now, what I would suggest is directly learn this formula. Because in exam you can't put this derivation and do it. See, in FM what happens? Unlike costing, everything can be told logically then and there. Whereas in FM, things can be told logically, but there are certain things that has a mathematical derivation, and mathematical derivation can be known only if you solve it. So this I can solve and show it to you. It will take about 10 to 15 minutes. Of course, the derivation and all is not there for exam. But if we take that extra 10 to 15 minutes, at the end of that, you will know, okay, fine. Hence proved contribution by EBIT. But now once again, you will just think, sir, but contribution by operating leverage is contribution by EBIT. Just like that, why is the logic? I can only prove it to you mathematically. But because this is not something like automatically, logically, you can just say mathematically only it can be proven. It is like asking why is pi is equal to 3.14, right? If you want, we can prove. It runs into pages. Of course, we cannot do. Yes, some legends have done it already, but something similar to that on a lower scale. This can be proved, and I'm deliberately not doing it in a marathon because see, in our regular lectures, generally, I derive this because it takes some extra time. It's not there for exam. Just know that operating leverage is equal to contribution by EBIT. Sir, is there a way to remember this? Absolutely. I'll tell you the way to remember this. I will tell you a way to remember this, logical way to remember that I will tell you. Now, look at this. Imagine a sandwich, okay, not a sandwich, a burger, okay. So if you see, how does a burger look like? So something will be on the top, you will have a base here, and in between you will have what you call this patty with all the vegetables and all that, right? So yes, I am a vegetarian, so I'm taking a veg burger here. Now look at this. Now, guys, fun aside, now look at this. Why does leverage happen? I told you, because of the presence of fixed cost. Operating leverage happens because of the presence of fixed operating cost. So imagine this burger. Your operating leverage is nothing but the top bun divided by lower bun. That is what your contribution divided by EBIT. So why this leverage happens? Because of the presence of fixed cost. Are you clear with this? You remember it like this. I'm not asking you to mug it up. This can be mathematically proven. But in exam, you can't do this derivation every time. So what you can do, just remember, this is nothing but why is my leverage happening? Operating leverage is happening because of my fixed operating cost. So till my contribution, the sales move proportionately, and after that, there is a disproportion, and that is the reason why the operating leverage is happening. Simple, contribution divided by EBIT. Are you clear with this? This is the formula that you need to remember. Are you clear with this, guys? Imagine the sandwich or whatever you call this burger. Are you clear with this? With this, you can understand this, and this is a very, very mathematically provable formula. Actually, if you have the time, maybe you can just try it by yourself, or in the regular lectures, if you have watched, well and good, right? But it is not required for exam. Don't worry about it. Now, no one is going to ask you to derive the formula for operating leverage and all. No, nothing of that sort. Now, one more thing that you need to understand. What did I say the formula for operating leverage was? The formula for operating leverage, the other formula is going to be what? contribution divided by EBIT. Now, this contribution and EBIT should be picked only from the base data. It should be picked only from the base data. Are you clear with this? So, it is going to be base data's contribution 10,000 divided by base data's EBIT. So, it's going to be how much? 10,000 divided by 5,000. Are you clear with this? It's going to be how much? It's going to be 2 times. Are you clear with this? So, you can't take the contribution divided by EBIT of any of the data. If you look at this here, 5,000 divided by 0, what will come? Nothing will come. Here, 15,000 divided by 15,000 divided by 10,000, you will get 1.5 something. No, no. Only on the base data from where you are seeing the change on that base data. The base data's EBIT. So the base data's contribution, these two should only be used. So base data's contribution divided by base data's EBIT is your other formula for operating leverage. Are you clear with this, guys? Are you all clear with this? And as simple as that. So what do you mean by an operating leverage? Yes, operating leverage talks about the relationship between the change in your EBIT and the change in your sales. Are you clear with this? So what is the formula for operating leverage? Two formulas. One is a logical formula. What is it? Percentage change in EBIT divided by percentage change in sales. The second formula is a mathematically derived formula. What is this? Sandwich or the burger. Contribution divided by EBIT, and you are done with this area. Are you clear with this? Yes. And what we are seeing, it is nothing but operating leverage shows the magnifying effect, magnifying effect that is because of the business risk. Sir, why is it called as business risk? Because here we are considering only the fixed operating cost. Are you clear with this? So generally speaking, fixed cost denotes risk. Sir, why is it risky, sir? If you have more fixed costs, it is the meaning of that is you are tend to be more risky. Why is it, sir? Because irrespective of whether you make a profit or a loss, a fixed cost needs to be paid. Correct or not? So more the fixed cost generally means more the risk. So then is it bad, sir? No. More the risk also means more the return. Risk means what? Uncertainty. It can be in your favor. It can also be against your favor. So don't think risk is bad. Risk is not negative. It can be positive or it can be negative. It's a double-edged sword. Are you clear with this? So this fixed operating cost, because of that only operating leverage is coming, and that is why we are saying that the operating leverage is actually considering what? Business risk. Are you clear with this? Yes. So that is what we've seen here in this first particular data. Now, one more thing that I want to share with you in this particular area of operating leverage. Yes, other relevant formulas relating to operating leverage. Okay, so let me just come back to this after we finish financial leverage. I think that would make more sense. So let us go to financial leverage and then we'll come back to operating leverage. We'll come to the other parts of this particular operating leverage. So all these things are very, very logical. In fact, these are certain things that are linked to our marginal costing chapter in our cost and management accounting. In costing paper, certain things are related to your cost and management accounting in that marginal costing. But anyways, we will see whatever this is. We will see all these things. Don't worry about it. I'm not omitting it. So let's go to the financial leverage, right? Now, what do you mean by financial leverage? What do you mean by financial leverage? Now, financial leverage studies the relationship between EBIT and EPS. Now, look at this. Operating leverage. I'm just erasing all these things off. So, operating leverage. What was the study in operating leverage? One second. I'm just erasing this. Yes. What was the study in operating leverage? In operating leverage, we were trying to find out the relationship between this figure, the sales figure, and what? The EBIT figure, correct? And that's why here I have put it as what? Degree of operating leverage. In fact, this entire chart is picked from the ICI study material only. They have given it. So operating leverage is about what? The study of relationship between your EBIT and your sales. Are you clear? It shows the magnifying effect between the sales and EBIT. What do you mean by financial leverage? It talks about the magnifying effect that happens between EBIT and EPS. Are you clear with this? EBIT and EPS, and this entire component. Again, why it happens? Financial leverage. Financial leverage also happens because of the presence of fixed cost, but wait, not fixed operating cost. It happens because of the presence of fixed financial cost. That is the two line items. Are you clear with this? I will prove it. Don't worry. Again, we will see an example. Are you clear with this? First, What does operating leverage talk about? Relationship between sales and EBIT. What does financial leverage talk about? The relationship between EBIT and EPS. Are you clear with this? Sir, can you give us an example? Absolutely. We will take an example here. One second. Yeah, we'll take an example here. Now, financial leverage, what does it talk about? Relationship between EBIT and EPS, right? Please learn all these things conceptually, don't mug it up. If you mug up, then automatically it's going to be very difficult. If you learn the subject like this, definitely it will be very, very interesting. I wouldn't say you'll start liking the subject, but definitely I can tell you one thing, it will at least be interesting. It will not be boring. Clear? So now, let me just take an example. It's an illustration. Now, I'm taking an existing data, that is the base data. Fine. Similarly, situation 1, scenario 1, scenario 2. All right. Fine. Now tell me that profit statement we saw starting from EBIT. So sales minus variable cost gives you contribution. Contribution minus fixed operating cost gives you EBIT. Let us start from EBIT. Why are we starting from EBIT? Because this particular financing leverage, it talks about the relationship between EBIT and your EPS. Correct? So basically, we are concerned about the second half of the profit statement. Are you clear with this? Yes. So now look at this. EBIT. Yes. Tell me the format. Minus interest gives you what? EBT, earnings before tax, minus tax. Let us assume the tax rate is 30%. Okay. Fine. Let's assume. So EBT minus tax is going to give you what? EAT. Yes. Earnings after tax. Then minus preference dividend. Gives you what? Earnings available for equity shareholders. Let me put it as EFE, earnings for equity shareholders. Correct? Divided by number of equity shares. It gives you what? EPS. Are you clear with this? Yes. Now, first, let us fill this up, and with this we will understand. It's the same concept, but here it is happening on the other side, in the second half of the income statement. Now, let us assume the EBIT is how much? Let us say the EBIT is 1 lakh rupees. Just an example. The EBIT is how much? The EBIT is going to be 1 lakh rupees, right? Now, minus interest. Let us say the interest is going to be 20,000. Will this change? No, it's a fixed financial cost. So whether it is situation 1 or situation 2 or the existing situation, this will not change. Correct or not? Yes. So what is the current earnings before tax? 1 lakh minus 20,000. This gives you how much? 80,000. Right? Minus tax at the rate of 30%. So on 80,000, calculate 30%. That's going to give you how much? 24,000. Right? Yes. So 80,000 into 0.3. That's going to give you 24,000. So now 80,000 minus 24,000 gives you how much? It's going to give you 56,000. Minus preference dividend. Let us assume preference dividend is 16,000 rupees. Now this is also one more component of what? Fixed financial cost. Correct? So whether it is situation 1 or situation 2 or the existing situation, this preference dividend will not change. Yes or no? Right? So now what is my earnings available to equity shareholders in the existing scenario? 56,000 minus 16,000 is going to be how much? 40,000. Right? And let us say the total number of equity shares available in the company is 10,000 number of equity shares. And the number of equity shares is also not going to change in these situations. Are you clear with this? So now you need to divide this. 40,000 divided by 10,000. How much is going to be? The earnings per share is going to be how much? 4.00. That is, every share earns a revenue, or every share earns rupees 4 of profit. That is the earnings for equity, earnings available to equity shareholders divided by number of equity share. This gives you 4 rupees. Now, let us say your profit, your EBIT is fallen by 10%. So from 1 lakh, it has become how much? Let's say 90,000 rupees. Or in other words, your EBIT has fallen by how much? 10%. Are you clear with this? So what will be your EBT? 90,000 minus 70,000. This gives 90,000 minus 20,000. This gives you 70,000. Correct? Now, on this EBT, tax of 30% gives you how much? It gives you 21,000 rupees. Yes or no? So EBT minus tax gives you how much? So EAT, how much is that? That is going to be 49,000. Yes, 49,000. So is this entire amount available to the equity shareholders? No. Out of this, the preference dividend of 16,000 needs to be paid. So 49 minus 16, the balance amount is how much? It's going to be 33,000. So 33,000 divided by 10,000 per share. Now the earnings becomes, EPS becomes 3.30. Now let's go to the other side. Let us assume that my EBIT is increasing by 10 percentage. Other things remaining constant. What is changing? Only my EBIT. By how much? 10 percentage, which means what? From 1 lakh, it is increased by 10 percentage. That is, it has increased to 1 lakh and 10,000. So now what's going to be my EBIT? One second, let me just put it properly. So now 1 lakh and 10,000. So now what's going to be my EBIT? So EBT is going to be how much? So 1 lakh 10 minus 20, that's going to be 90,000, right? Minus tax, how much is it? 30 percentage on this, it's going to be how much? 27,000, correct? Yes. Yes. So now what is going to be your earnings after tax? That's going to be 63,000. Yes. Now is this entire amount available to the equity shareholders? No. Out of this, the preference dividend needs to be paid. So 63 minus 16, this gives you how much? 47,000 is your earnings available to equity shareholders. So what is the earnings available per share? Earnings per share. 47,000 divided by 10,000, it's going to be 4.70. Are you clear with this? Now, you tell me, if you tell me, if my sales increases by 10 percentage, correct? From, please remember, this always, leverages always has to be calculated in terms of percentage. Don't say if the sales increases by 10,000 rupees. No, 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 no. It should always be calculated in proportions in terms of percentage. If my sales increases by 10 percentage, what happens to my EPS? My EPS is increasing, correct? By how much? By how much is it increasing? The increase in EPS is how much? 0.7, correct or not? The increase in EPS is how much? 0.7. Yes, 0.7 divided by 4. How much is this? 0.7 divided by 4 into 100. So can I say my EPS increases by 17.5 percentage? Yes or no? How did you get 17.5? What is the increase in EPS? 0.7. 0.7 divided by the base 4 is going to give you how much? 17.5 percentage. So can I say if I increase my EBIT by just 10 percentage, your EPS increases by a whopping 17.5 percentage. But wait, if your profit decreases by just 10 percentage, your EPS will decrease by how much? 17.5 percentage. We will see that. Look at this. So now in this case, what happens? So my profit reduces, EPS reduces from 4, it becomes how much? 3.3. So how much the reduction? Minus 0.7. So we just saw 0.7 divided by 4 is going to be how much? So it's going to be 17.5. So minus 0.7 divided by 4 is going to be minus 17.5 percentage. Or in other words, can I say if my EBIT increases or decreases, if my EBIT changes by 10 percentage, my EPS changes by 17.5 percentage. There is a magnifying effect here on the financial side, and hence it is called as financial leverage. What's the formula for financial leverage? Percentage change in EPS divided by percentage change in what? Percentage change in your EBIT. Are you clear with this? So percentage change in EPS is how much? It could be plus or minus 17.5 percentage divided by plus or minus. You can take yes, 10 percentage, right? So it's going to be how much? It's going to be 1.75 times. I can say 1.75 times is going to be what? It is going to be my financial leverage, or in other words, the magnifying effect is what? If my EBIT increases by 1 percentage, my EPS will increase by 1.75 times that 1 percentage, or in other words, 1.75 percentage. Here what happened? My profit EBIT increased by 10 percentage. So now EPS is increasing by how much? 1.75 times the 10 percentage, that is 17.5 percentage. Are you clear with this? Similarly will happen if the EBIT reduces. If the EBIT reduces by just 10 percentage, now EPS will reduce by 17.5 percentage. It's a double-edged sword. Are you clear with this? Are you clear with this? Now, sir, why is this effect of? Why is this financial leverage? Why is this happening? This financial leverage, why is this happening? Now, very simple. Let me just take the same figures here. 1 second. I think I can just copy paste it. One second. Perfect. Right. I think I should have done this before also for the previous example. Okay. So let me just erase a few things. Why is this happening? Why is this happening? This is happening purely because of the fixed financial cost. Sir, in this case, fixed financial cost means what? Interest and preference dividend. Let us assume the company does not have any interest or preference dividend, or in other words, the entire source of finance for them is only through the equity share capital. Now, what will happen here? I'm just erasing all of this. There will be a change. So I'm just erasing this. So 1 second. So yes, this is also smart work, leverage only, copy paste work. Now look at this. Now let's assume there is no interest in all the three situations. What will happen to my EBIT? So what EBIT is, I told you, it's 1 lakh, 1 lakh 10,000, 90,000, three scenarios. Let us assume no fixed financial cost. Fixed financial cost means what? Interest and preference dividend. So what happens in the existing case? My EBT will be 1 lakh, and in this case it will be 90,000. In this case it's going to be 1 lakh 10,000. Correct? Yes, minus tax rate of 30%. So now tell me, what is your tax going to be here? The tax is going to be how much? The tax is going to be 30,000. Yes, the tax is going to be 30,000. Here the tax is going to be 30% on 90,000. It's going to be 27,000. And here it's going to be how much? 33,000. Correct or not? Yes. So now what is going to be your EAT? Here it's going to be 70,000. Here it's going to be 63,000. Yes. And then here it's going to be how much? 77,000. And now let us say there is no preference dividend also. Fine. Now what happens to my earnings for equity? It becomes 70,000 here. Yes. Here it becomes 63,000. Here it becomes how much? 77,000. Yes or no? Fine. And now what happens to my EPS, guys? So what happens to my EPS? Now let's do this. Let's do this. So what happens to my EPS? So now EPS here in this case, it becomes how much? It becomes so let's see, it becomes how much? 70,000 divided by 10,000, it's going to be how much? 7, right? Yes, in this case, it becomes how much? 7.70. So here it's 7.00. It's 7.70. That is 77,000 divided by 10,000. Here it becomes 63,000 divided by 10,000. It becomes 6.30. Now you tell me. Now, if I increase my sales by how much? 10%. Correct? 10,000 upon 1 lakh is going to be 10%. Now, what happens to my EPS? What happens to my EPS? What happens to my EPS? My EPS is going to be how much? My EPS is increasing by how much? From 7, it became 7.7. So, what is the change? Change is going to be 0.7 divided by the base 7 into 100. So, how much is this going to be? 0.7 divided by 7 is going to be what? 0.7 divided by 7 is going to be 10%. Are you clear with this? Are you clear with this? So, here what happens? If I increase my EBIT by 10%, my EPS is also exactly changing by 10%. If I decrease my EBIT by 10%, from 1 lakh, it became 90,000. That is, it fell by 10%. What happens here? It's going to be how much? From 7, this falls by how much? Falls to 6.3. That is, it falls by minus 0.70. Correct? 7 minus 0.7 is only going to be 6.3. Minus 0.7 divided by 7 into 100. It means what? My EPS falls by how much? 10%. Or in other words, there is no magnifying effect. Correct? If my EBIT increases or decreases by 10%, my EPS is also moving, that is increasing or decreasing by exactly 10%. Or in other words, can I say in this case, the financial leverage is equal to percentage change in EPS divided by percentage change in EBIT. Here it's going to be EBIT. Here it's going to be plus or minus 10% upon plus or minus 10%. That gives you a leverage of 1, no magnifying effect, and hence it is proved. What is proved is that this magnifying effect is happening only because of the presence of these two guys. That is the interest and the preference dividend. Are you clear with this? These two are nothing but fixed financial cost. Are you clear with this? That's why I said tax is not a fixed financial cost. Because look, proportion to your EBIT, your tax will also change. Correct or not? So everything moves in proportion. What makes this entire statement disproportionate is only these two guys. That is, these two components of fixed financial cost, interest and preference dividend. So only because of the fixed and only because of the interest and preference dividend, in this case, you are having what? You are having a magnifying effect on the financial component of your income statement, and hence the name financial leverage. Are you clear with this? And why is this happening? Because of the presence of fixed financial cost, or in other words, fixed financial cost is nothing but interest and preference dividend. And this is also being proved. So what is the formula for financial leverage? The financial leverage formula is percentage change in EPS divided by percentage change in EBIT. Now there is one more formula for this, direct formula. Again, it's a mathematically derived formula, and I'm not getting into the derivation right now, but it can definitely be proven. I can prove it, but yes, it's not required for the exam, so I'm not doing it in a marathon, right? So now, what is the other formula for financial leverage? Now, financial leverage, the same concept of the sandwich or burger example only. Financial leverage can be called as EBIT divided by EBIT minus interest minus preference dividend upon 1 minus T. Right? Now, sir, why all these formulas? Why is it coming like this? As I told you, it has to be mathematically proven. Mathematically, definitely we can prove it. That shouldn't be a problem. But in exam, you should know, like you should have something in your mind to remember why we have this formula. And it is not like memory technique and all, but you should have some logic that is attached to this formula, a directly applicable logic. Yes, derivation is one part, but you can't remember the entire derivation, or you can't do the derivation in exam. So logically, sir, can you tell me a quick way to remember this formula? Yes, I will tell you. Simple, guys. What was the operating leverage formula? Operating leverage was what? EBIT, sorry, the operating leverage was contribution divided by EBIT. So EBIT means what? Contribution minus fixed cost, fixed operating cost, correct or not? That is contribution, correct, divided by contribution minus fixed cost. That is, from the contribution you remove whatever is the fixed operating cost that is inside it, so that you will get your what? You will get your EBIT. That's what we did there. Operating leverage. I'm not talking about financial leverage. I'm talking about operating leverage. Correct. Contribution divided by EBIT. So what is EBIT? EBIT is nothing but contribution minus fixed cost. Correct or not? So can we say it is nothing but contribution divided by contribution minus fixed operating costs? Correct. Similarly, here it is going to be what? It is going to be EBIT divided by EBIT minus the two fixed financial costs. Are you clear with this? That is EBIT minus EBIT divided by EBIT minus interest minus preference dividend by 1 minus T. Are you clear with this? That is EBIT divided by EBIT minus the two fixed financial costs. Only because of the two fixed financial costs you are having this leverage, financial leverage, correct or not? Yes. Now I can hear your doubt. One more thing. Sir, why for preference dividend alone you have put 1 minus T? Mathematically it is coming like that, but I can give you one more logic for it. Now you tell me here what we are doing. The denominator alone you just see EBIT minus interest minus preference dividend upon 1 minus T. This is what we are getting. Yes. Now you tell me EBIT, this component, this figure comes before tax or after tax? Tell me guys, it comes before tax or after tax? It comes before tax. Tax is only here, before tax, correct? Yes. Interest is a component that comes before tax or after tax? It comes before tax. Whereas preference dividend is a component that comes after tax, correct or not? Yes. So now I am saying that EBIT, interest are all pre-tax items, correct? They are readily comparable. Whereas preference dividend is a post-tax item, correct? So what you need to do is you should convert that post-tax item into a pre-tax item. Are you clear with this? How will you do it? If there is a pre-tax item, to convert it into post-tax, what you will do? That item into 1 minus T. But if you have a post-tax item, if you want to convert it into pre-tax, what do? Divide it by 1 minus T, correct or not? So since this is a post-tax item, I'm converting it into pre-tax item to make this readily subtractable with the other two components. Are you clear with this? Logically, you just understand this, but this is mathematically proven. Beyond this, nothing can be told, but this is mathematically provable. You'll run into 2-3 pages and you can prove this. Hence proved, you will get it. But I'm telling you, easy way to remember for the exam, no memory techniques and all. Remember, EBIT divided by EBIT minus the two fixed financial costs because of which the financial leverage is happening. But in this EBIT, minus interest can be done, but minus preference dividend directly I cannot do. Why? Because fixed preference dividend is happening after tax. It is a post-tax item, correct? So divided by 1 minus T. Please don't confuse this with tax shield and all. This has nothing to do with tax shield. Preference dividend doesn't have a tax shield. This has nothing to do with tax shield. So please don't confuse this with the KD, that calculation with this. Are you clear with this? This is a mathematically proven formula, but I'm just giving you an easy way to remember, as simple as that. Are you clear with this? So what is the formula here? EBIT divided by EBIT minus interest minus preference dividend upon 1 minus T. Why for preference dividend alone you are doing divided by 1 minus T? Because it's a post-tax item. I am converting it into a pre-tax item. Only then it can be subtracted from the other two pre-tax components. Are you clear with this? Just remember it like this. No way you can forget it in exam. Are you clear with this? Logic, guys. Every single thing is logic, and this is mathematically provable also. Now, one more thing. Suppose preference dividend is not there. So the company has not raised any money through the preference channel. Can I say this is nothing but EBIT? So financial leverage, can I say this is nothing but EBIT divided by EBIT minus interest, correct? Or can I say this is nothing but EBIT divided by EBT, correct or not? If there is no preference dividend, then financial leverage is nothing but EBIT divided by EBT, correct? That sandwich comes in. Are you clear with this, guys? Are you clear with this? Yes. Now, what happens? I will tell you the irony here. What happens? Now, look at this formulas here. Yes, so fixed your financial leverage, percentage change in EPS upon percentage change in EBIT. You got this? Yes. Then financial leverage formula, EBIT, see, EBIT minus interest minus preference dividend by 1 minus T. This is the right formula, correct? And if there is no preference dividend, I can say that financial leverage is EBIT upon EBT. Are you clear with this? Are you clear with this? But now there is one small issue that I want to address. Now what happened in institute study material, in some sums, even when there is a preference dividend, they have used this formula. Or in other words, for the purpose of computing the financial leverage, they have conveniently ignored the preference dividend. Sir, is it correct? No, technically not. But globally, some people still take this formula. They ignore preference dividend completely. Some people take this formula. Sir, don't tell me all these things. For exam, what I should do? In exam, certain questions have been solved like this. Certain questions have been solved like this. So whatever you solve, please write a note, because this is an area of controversy, right? You write a note saying that, see, if there is a preference, see, when there is no preference dividend, obviously this formula only you will take. When there is a preference dividend and still you want to use this formula, that is, if you want to ignore preference dividend, maybe you write a note saying, yes, this has been done like this. But I would prefer you use this formula, not a problem at all. We will be doing it somewhere. In the study material, they have, even when there is a preference dividend, they have ignored this formula and they have written it as EBIT upon EBT. So let's not question it back. This is how the situation is right now. So accept it. Are you clear with this? Fine. Are you clear with this? So now, guys, tell me, what is the formula for financial leverage? Percentage change in EPS divided by percentage change in EBIT, or the other formula is what? EBIT divided by EBIT minus the two fixed financial costs, that is EBIT minus interest minus preference dividend upon 1 minus T. Why preference dividend alone upon 1 minus T? Because it's a post-tax item. I am converting into pre-tax to be readily subtractable from my EBIT. Are you clear with this? Now, in some cases, what they do, they ignore the preference dividend and they write it as EBIT upon EBT. Are you clear with this? This is the entire story about your financial leverage. Are you clear with this? Yes. Now, what do you mean by a combined leverage? Don't worry, I'll come to that operating leverage, margin of safety and all. Don't worry about that. I'll come. What do you mean by combined leverage? It is a combination of your operating leverage and your financial leverage. Or in other words, it shows combined leverage talks about the relationship between the topmost item and the bottommost item. Are you clear with this? That is, it shows the relationship between the sales and your EPS. Are you clear with this? So, operating leverage talks about the first half of the income statement. Financial leverage talks about the second half of the income statement. Combined leverage talks about the entire income statement. Are you clear with this? Or very simple. Combined leverage is nothing but operating leverage into financing leverage. Are you clear with this? Operating leverage into financial leverage. Are you clear with this? Or you can use this formula. So operating leverage, what is the formula? Contribution upon EBIT, correct? Financial leverage, what is the formula? EBIT upon EBT. Yes, there's an alternate formula. EBIT divided by EBIT minus interest minus preference dividend upon 1 minus T. Yes, that also you can use. In this case, we have just considered this, right? I'm just giving it as given in the study material. Correct. In the study material, this is also given. Please note, don't think I'm doing something out of my own. In some sums, they have done this. In some sums, they have done this. Are you clear with this? So what you need to do is, So combined leverage is what? Nothing but operating leverage into what? Into your financing leverage. Operating leverage is contribution upon EBIT. Yes, your financing leverage is EBIT upon EBT, or alternatively EBIT upon EBIT minus interest minus preference dividend by 1 minus T. Correct. Now EBIT anyways gets knocked off. Correct. So your combined leverage formula is what? Contribution divided by EBT. Are you clear with this? Or alternatively, the right precise, technically the right formula is contribution divided by EBIT minus interest minus preference dividend upon 1 minus T. Technically, this is how it should be. Correct? If you're ignoring preference dividend, use this formula. If you're not ignoring, if you're considering preference dividend, use this formula. As simple as that. Let me just make this very simple to you. Are you clear with this? Sir, when to use what in study material? They have used this, that. Yes, I know. That is why I am telling you very clearly, when preference dividend is that, ideally it should be considered, but in some questions, institute has not considered it. Are you clear with this? Why and all? I don't know why they have not considered, but generally, they have done certain sums by considering it, certain sums, even when preference dividend is not there, they have not considered it. So I don't know why. So what you need to do is just write a note and leave it there. Always remember, when you have some controversy, you write a note that is backing your assumption. For the given note, your answer is correct. So no one can touch your marks. Clear with this? Do that smart way. Always strategize and do it. Whichever subject you are doing, if there is a controversy, then you do it. Now you can't, you see, only when there is a controversy or when there is an ambiguity, you can use note that will come to your rescue. Just like that, see, in this case, the preference dividend is not at all there. Still, I want to use this formula that is not at all a question. So not everywhere you can write this note and you can escape. No, I'm not saying like that. When there is a controversy, yes, confusion, it can be avoided by way of writing a note. And for the note that you have written, your answer is correct. That's about it. Are you clear with this? Yes. So now that's about your combined leverage. Or in other words, combined leverage talks about the change in your EPS when there is a change in my topmost figure, sales. So percentage change in EPS divided by percentage change in sales, or there's nothing but your operating leverage into into financial leverage. Operating leverage was EBIT, percentage change in EBIT divided by percentage change in sales. Correct. What is your financial leverage? Percentage change in EPS upon percentage change in EBIT. These two gets knocked off and you get finally percentage change in EPS divided by percentage change in sales. Are you clear with this? Or in other words, it talks about the relationship between my EPS bottommost item with my sales, my topmost item, and this is called as combined leverage. Are you clear with this? Now your operating leverage is happening because of the presence of fixed operating cost. That is for the purpose of your operations. That's why operating leverage is actually an indicator of your business risk. Are you clear with this? Financial leverage, why is it happening? Because of the presence of fixed financial cost, and that's why this represents your financial risk. Are you clear? I told you fixed cost generally represents risk. Are you clear with this? And combined leverage is a combination of both business and finance risk. That's why it is called as the overall risk. Are you clear with this? Guys, learn it like this so that you will not forget this for a lifetime. Are you clear with this? And as simple as that. Sir, why are you calling this as risk? Magnifying effect is there. No, sir. Look, magnifying effect. Let's say your operating leverage is 2 times. If your profit increases by 10%, your EBIT, if your sales increases by 10%, EBIT will increase by 20%, no doubt. But if your sales decreases by just 10%, the decrease in profit will be 20%. So it can work for you, it can also work against you. This is like a seesaw, correct? If you put if you are favorable, you can put the other person up. But if that person is going to be favorable, now you will also go up. Are you clear with this? So basically, you can put the other person up or you can put the other person down. Automatically, it works both the ways. Are you clear with this? So this is a magnifying impact that we are talking about in this particular chapter. So the relationship between sales and EBIT, operating leverage, EBIT and EPS, that's going to be your financial leverage, and sales and your EPS is going to be your operating leverage. All the formulas we have just studied logically, conceptually, and that's about it. Are you clear with this? Now, one more thing that we need to do, this is something to do with the costing area. Yeah, so let me just quickly finish this off. So what is this? 1 second. So what do we have here? Yes, there are some relevant formulas relating to operating leverage. So let's just study this relevant formulas relating to operating leverage. Now, break-even point in units is equal to fixed cost by contribution per unit. This is actually a costing area, marginal costing, fixed cost divided by contribution per unit. Margin of safety is sales minus break-even sales divided by total sales into 100, and degree of operating leverage is 1 divided by margin of safety as a percentage. So what is all these things? Fine. I'll just give you a small background with a numerical example and we'll be done with this. I'm not getting into the technicalities because this is not costing, this is FM, right? So to the extent relevant, I will definitely explain, and I will also prove that operating leverage is 1 divided by margin of safety as a percentage. See, some students, what they say is operating leverage is equal to 1 divided by margin of safety. Please don't make that mistake. You always tell yourself operating leverage is equal to 1 divided by margin of safety as a percentage. Immediately put that, because this margin of safety has to be expressed as a percentage. It can also be expressed in amount, but if you do that in amount, you will not get operating leverage. Are you clear with this? So operating leverage is 1 by margin of safety expressed as a percentage. Always say this along so that you will never forget it. Now, what is all these things? What is a margin of safety? First of all, let me just give you an example. Let us just say this requires some basic level of costing knowledge, some very basic level of costing knowledge. Let's say this is the given data. Sales is equal to 1 lakh rupees. Just an example, guys. Yes. Now let's say the variable cost, let us say is 25%, that is 25,000 rupees. The variable cost is 25,000 rupees. So what is going to be your contribution? The contribution is going to be 75,000 rupees. Are you clear with this? So can I say the variable cost ratio, the VC ratio, can I say is nothing but 25%? That is variable cost expressed as a percentage of sales is called as VC ratio. Similarly, contribution expressed as a percentage of sales is called as PV ratio. It's called as profit volume ratio. 75,000 upon 100, 75,000 upon 1 lakh is going to be how much? 75%, right? Minus fixed cost, basically fixed operating cost. Let us say the fixed operating cost is how much? Let's say it's 60,000 rupees, right? Now, what will be your EBIT? Your EBIT is going to be how much? Your EBIT is going to be 15,000. 15,000. Are you clear with this? Yes. Now, sir, in this case, what is the operating leverage? Can you calculate? Operating leverage is equal to what? Now, here only one data is given, correct? If more than one data is given, with that percentage you can calculate. Since only one data is given, use that sandwich or that burger formula, contribution divided by EBIT, correct? So it's going to be contribution upon EBIT. Yes or no? So contribution is going to be how much? 75,000. EBIT is going to be how much? 15,000. So 75,000 upon 15,000, can I say my operating leverage is 5 times? Or in other words, when my sales increase by 1%, my EBIT increases by 5%. The magnifying effect is 5 times. Are you clear with this? Yes. Now, fine. This is about it. This is what we have already seen. Now let us go back to a little bit of costing. First, calculate the break-even point. Sir, what do you mean by break-even point? The point of sale that makes my EBIT 0 is called as a break-even point, correct? Yes. So what do you mean by the break-even point in this case? Sales minus variable cost gives you contribution minus fixed cost gives you your EBIT, correct? Now let's reverse work. Now, EBIT. So I should calculate the break-even point. Break-even point means what? The point of sale where I'm earning exactly a 0 profit, 0 loss. No profit, no loss scenario. So first I will start from here. So for me to earn 0 EBIT, now fixed cost, will it change? No, fixed cost remains to be 60,000. It means that I should be earning a contribution of exactly 60,000, correct? Or in other words, my contribution should be able to recover exactly my fixed cost, correct or not? Only then I will be making a 0 EBIT, correct? And now we know that contribution is what? 75% of the sales. Yes or no? That is the PV ratio, correct? Yes, if 75% has to be 60,000, how much should be 100%? 60,000 divided by 75 into 100. So can I say, so your sales should be 80,000, correct or not? Or in other words, if this is 80,000, 25% of this will go off. That is 20,000 will go towards your variable cost. So you will make a contribution of how much? You will make a contribution of 60,000, and exactly your fixed cost will be recovered, and you will end up in a no profit, no loss scenario. Are you clear with this, guys? Are you clear with this? Or in other words, break-even point I can find out directly. How can I find out? It is nothing but fixed cost divided by PV ratio, right? This is actually subject matter of discussion in your costing. But anyways, if you want the break-even point to be expressed in value, The sales at which I earn a zero profit, zero loss is called as the break-even point. Are you clear with this? Yes, are you all clear with this? Suppose you want the break-even point in units, it's called as fixed cost divided by contribution per unit. So this is how it happens. Now, now, you tell me, what is the total sales that the company has made actually? 1 lakh rupees, correct? The company has made a total sales of worth how much? 1 lakh rupees, correct? Now, the break-even point happens at how much? 80,000 rupees, correct or not? Yes, which means if you make sales up to exactly at 80,000 rupees, no profit, no loss for you. Are you clear with this? So if you make sales beyond this 80,000 rupees, then you will start earning profit. And that is the reason why for a 1 lakh rupees sale, it is reporting a profit, EBIT. Are you clear with this? Or in other words, how much rupees of sales has been made in excess of the break-even point? Can we say beyond the break-even point, the company has made 20,000 rupees worth of sale, correct? And this is called as margin of safety. In costing, we call this as margin of safety. Technically, this is not even an FM area. This is called as margin of safety. It's in costing, marginal costing. Now, margin of safety is what? The sales made beyond the excess, beyond the break-even sales, correct? Now, this margin of safety is how much? 20,000 rupees. Now, this can also be expressed as a percentage of the total sales. So, if I'm asking, so I want to know margin of safety as a percentage of total sales. Can I say margin of safety as a percentage of total sales is nothing but 20,000 divided by 1 lakh. How much is that? 20,000 divided by 1 lakh. How much is that? Can I say 20,000 divided by 1 lakh? It's going to be how much? 0.2, right? Can I say this is nothing but 0.2? Yes or no? Yes or no? So, can I say 20 percentage or my margin of safety is 0.2? 0.2 percentage of my or 20 percentage of my overall sales. Are you clear with this? So you now got to know how to compute this margin of safety as a percentage. Now what they have given, operating leverage is equal to 1 divided by margin of safety as a percentage. Now you try to apply this formula and see if you are getting the same answer. 1 divided by 0.2. How much is 1 divided by 0.2? 1 divided by 0.2 gives you how much? 5 times. So this is the exact answer that we got here also in the beginning. Yes, contribution divided by EBIT, if you do that, you are getting 5 times. If you use this formula, 1 divided by margin of safety as a percentage, you are getting the same answer as 5 times. Are you clear with this? So these are also mathematical equations that can only be proven. So always remember this, operating leverage is equal to 1 by margin of safety as a percentage. And what do you mean by margin of safety? Margin of safety means what? The sales made in excess of the break-even sales. And if you want to express this margin of safety as a percentage of total sales, what will I call this as? How will I do it? Total sales minus break-even sales, correct? That is your margin of safety divided by total sales. Are you clear with this? That is the margin of safety as percentage, and that is what they have given here. Margin of safety as a percentage is going to be what? Total sales minus break-even sales divided by total sales. In this case, it was 100,000 minus 80,000 divided by 100,000, correct? That is 20,000 divided by 100,000 or 1 lakh. That's going to be how much? 0.2. And 1 divided by 0.2, you get how much? Exactly 5 times. Are you clear with this? There is an alternate formula that you can use for calculating the operating leverage. These are purely mathematical, nothing conceptual here. Are you clear with this? Now, with this, we have seen all the formulas that are covered in this particular chapter. So now let's quickly summarize this before we get into the problems. So now tell me, so leverages in this chapter, there are how many types of leverages? 3 types of leverages: operating leverage, financial leverage, and combined leverage, correct? Operating leverage. What is the formula for calculating? Logical formula for operating leverage: percentage change in EBIT divided by percentage change in what? Percentage change in sales, correct? Or there is another formula here. What is this other formula? Sandwich formula, that is contribution divided by EBIT. Are you clear with this? Then, or one more formula is there. I'm putting it here. Just now we saw 1 divided by margin of safety as a percentage. This is one more formula that we saw right now. Next, financial leverage. Financial leverage talks about relationship between what and what? The second half, EPS and EBIT. So percentage change in EPS divided by percentage change in EBIT. Are you clear with this? Yes. Or this formula, what you can use here is EBIT divided by EBIT minus interest minus preference dividend upon 1 minus t. And I told you in some cases the preference dividend is being ignored and they are just writing it as EBIT upon EBIT minus interest, or in other words EBIT upon EBT. That's another way that can be written. Combined leverage. Combined leverage. What is the formula here? Combined leverage. It talks about the relationship between the bottommost and the topmost. Percentage change in EPS divided by percentage change in your sales. Are you clear with this? And the formula approach, what is it? Very simple. The formula approach, what will you do? So it is nothing but operating leverage into financial leverage. Yes, that is another formula. Operating leverage into financial leverage, or this into this. You just cancel it out. You get contribution divided by EBIT minus interest minus preference dividend upon 1 minus t. Are you clear with this? The entire chapter summarized in this particular chart. Very, very simple, provided you know this conceptually. What is the difficulty in this area? Very, very simple. And any kind of questions in this area you can tackle. Are you clear with this? So with this, let us get into the practical problems in this particular chapter. So now let's solve the first question, the question number 1. So let me read out the question for you. The capital structure of RST Limited is as follows. Equity share of 10 each, the value is 8 lakhs. 10% preference shares of rupees 100 each, the value is 5 lakhs. 12% debentures of 100 each, the value is 7 lakhs. The total is going to be 20 lakhs. Additional information. Profit after tax with a tax rate of 30%, the profit after tax is 2,80,000. Operating expenses including depreciation of 96,800 are 1.5 times of EBIT. What is operating expenses? What is operating expenses? This is nothing but your variable cost plus your fixed cost. That is the variable cost plus fixed operating cost put together. Be very careful. They have not mentioned the fixed operating cost. No. They have just mentioned operating expenses. Meaning what? What are all the expenses that you consider in costing? That is your variable cost plus fixed cost. Those two put together is 1.5 times your EBIT, and this includes what? Depreciation of 96,800. Then equity dividend paid is 15%. The market price of equity shares is 23 rupees. Now, what have they asked? What is the required part in the question? So they have asked calculate what? The operating leverage. 1 second. Yes, calculate the operating and financial leverage. Perfect. Cover for preference and equity dividend. That is preference dividend coverage ratio, equity dividend coverage ratio. Then the yield earnings yield ratio, price earnings ratio, net fund flow. Note all the operating expenses excluding depreciation are variable. So basically this overall this operating expenses is 1.5 times the EBIT, correct? So out of this they are saying only this 96,800 is fixed. So whatever is the balance, it is going to be variable cost. Now one more thing, sir, what are these three things? These three things are ideally a part of ratio analysis chapter. But in exams, what they do is they mix that along with this particular chapter, leverages. So anyways, these are also very, very practical. Guys, please don't mug up anything in ratio analysis. I will give you the logics also. We will do this. I will logically explain whatever these, these ratios stand for along with the formula, and we can get it done. Fine. So shall we get started? Yes. Now, how do we get started with this? The first thing that you need to do for all these leverage sums is that you need to prepare that statement, that is the profitability statement you need to prepare. So let me just put it here. So this is the first question that we're solving in this chapter. So what is the profit statement? Sales minus variable cost gives you contribution minus fixed cost, that is fixed operating cost, gives you EBIT, correct? So minus interest gives you what? EBT, earnings before tax. Then minus tax, in this question they have given at the rate 30%, right? So tax is 30%. Yes, tax the rate of 30%. So EBT, earnings before tax minus tax, gives you what? EAT, earnings after tax, correct? Yes, and then so from earnings after tax minus what? Preference dividend. Minus preference dividend, you get what? You get net profit available for equity shareholders, or we will call this as EFE, that is earnings for equity shareholders. Earnings for equity shareholders, correct? EFE, you will just call it like this. Fine. And then have they asked for EPS and all? I don't think so. So they have not asked for EPS, so we can stop it here. Are you clear with this? Now, let us plug the data given in that question. Profit after tax is how much? 2,80,000. So profit after tax. So this figure is how much? 2,80,000. So this figure they have given. So see, when you are doing this in exam, immediately what you do, you open three columns. You open three columns. That is, the first column should be for, the first column, second column, and the third column. The first column is for all these line items. The second column is for the amount. And the third column, you just put it as workings. You just put it as workings. So instead of writing a working note for everything, that is working note 1 coming down and writing, parallelly, if you give the calculation, that is also accepted by the institute. Are you clear with this? Now, against every figure, you should write how you got the figure. Now, in this case, what is this figure? What is this figure? Earnings after tax, 2,80,000. How did we know? Given. Correct? Yes, we will put it as given. Then, what else have they given? What else have they given? Now, tax rate is given. Okay, so 10% preference shares, 12% debentures. So all these data is given. Now, tax rate is how much? 30%. So we know that if the EBIT is 100%, the tax is 30, and obviously the earnings after tax is how much? 70. Correct or not? So now, if 2,80,000 is 70, how much is 30? We can reverse work and calculate. Yes. So what is that going to be? 2,80,000. So into 30 upon 70. So if 2,80,000 is 70, how much will be 30? So 2,80,000 into 30 upon 70. So that's going to be how much? 1,20,000. Are you clear with this? So this is going to be 1,20,000. So now with this, you can calculate what? You can calculate the EBT figure. Yes, you can calculate the EBT figure. EBT figure is nothing but EAT plus tax. So you can reverse work. So how much is this? 2,80,000 plus 1,20,000. So 2,80,000. So 2.8 lakhs plus 1.2 lakhs. So how much is this going to be? This is going to be 4 lakhs. Are you clear with this? Are you clear with this? Yes. So we have reversed worked and we have computed this particular area. Now next, do we have the interest figure with us? Yes, we can calculate interest. So how do we know the interest figure? Now, in this question they have given, it is 12% debentures. The value of the debentures is 7 lakhs. So 7 lakhs into 12%. So you can just write down here against interest, 7 lakhs into 12%. So how much is 7 lakhs into 12%? So 7 lakhs into 0.12, that gives you 84,000, right? That gives you 84,000. Right? So EBIT minus interest is EBT. So what is EBIT? EBT plus interest. So EBIT is going to be how much? The balancing figure, that is 4 lakhs plus 84,000. 4 lakhs plus 84,000. It is going to be how much? 4,84,000. 4,84,000. Yes, right? And of course, preference dividend also we have got in the question. 10% on 5 lakhs. So preference dividend figure is also available. So it is going to be 10% on 5 lakhs. So 5 lakhs into 10%. So how much is that? 50,000 rupees. Correct. It's going to be 50,000 rupees. So what is the amount of earnings available to equity shareholders? It is going to be 2,30,000. Yes or no? So this is going to be 2,30,000. Right? Are you clear with this? So the second half of the second half of the P&L we have finished. So it's going to be how much? 2,30,000. Am I right? So this is 10% on 5 lakhs. That's right. Fine. Are you clear with this? Yes. Now, let's go above. Now, sir, beyond this, how do we crack this question? Now, look at this hint given. Operating expenses, that is variable cost plus fixed costs put together is how much? 1.5 times the EBIT. Correct or not? And they have also given very clearly in the question that all the operating expenses excluding depreciation are variable, which means what? The only fixed operating cost that you have is this 96,800. Correct or not? Yes. So can we say 96,800? This 96,800 is the only fixed operating cost. Yes. So how do we know? It is given in the question. So this 96,800 is the only fixed operating cost. It is the only fixed operating cost. Yes or not? Yes. Now, so remaining components, how can we find out? Very simple. The total of variable plus fixed cost is 1.5 times the EBIT given in the question. So how much is the EBIT? The EBIT is 4,84,000, correct? So operating expenses is equal to 1.5 times of EBIT. How do we know? This data is given in the question. Operating expenses is nothing but variable cost plus fixed cost, and this is equal to how much? 1.5 times the EBIT. What is the EBIT? It is 4,84,000, correct? It's going to be 4,84,000. Now 4,84,000 into 1.5, how much is this? So this is going to be 7,26,000. So 7,26,000 is equal to variable cost plus fixed cost. How much is the fixed cost? We know the fixed cost here. It is given in the question as 96,800. Correct? So 96,800. So the total operating expenses is 7,26,000, out of which 96,800 is your fixed cost. So the remaining is going to be your variable cost. So your variable cost is equal to 7,26,000 minus 96,800. Are you clear with this? So this is going to be how much? So this is going to be, so variable cost is going to be 6,29,200, right? So variable cost is going to be 6 lakhs. Yes, so 6,29,200. Maybe you can give this a working note reference, 6,29,200. So we can put it here as 6,29,200, and you can use this working note reference, right? Now, what is the contribution? We know. So you have the EBIT, you have the fixed cost. So EBIT plus fixed cost gives you contribution, correct? Reverse working. So how much is that? 4,84,000 plus 96,800. That gives you how much? That gives you that gives you 5,80,800. Yes. So that gives you 5,80,800. So this gives you how much? 5,80,800. So 5,80,800. And how did we get this? It is 4,84,000 plus 96,800, right? So now what is going to be the sales? Sales minus variable cost is your contribution, or sales is equal to contribution plus variable cost. Or in other words, this is going to be 5,80,800 plus 6,29,200. So 5,80,800 plus 6,29,200. So how much is this? So plus 6,29,200. So it is going to be 12,10,000. So this is going to be how much? 12,10,000. Are you clear with this? See how beautifully we can solve this. It is all about the reverse working. So for our explanation, all these black ink items are actually given data. Fine, or it is directly calculatable data. The reverse worked figures, I have put it in blue ink. Now in exam, you don't have this luxury because you can only use a black color ballpoint pen. So in exam, you don't have this luxury. So don't do all these things in exam. But right now I'm doing it so that you can understand it much better. So now we have the entire income statement. With this, let us just proceed and answer whatever is the data that is being asked for in the question. Now, first, what have they asked? Operating leverage and financial leverage. Guys, very simple, very simple. What is the operating leverage formula? Operating leverage is contribution upon EBIT, correct? So how much is my contribution? So contribution is going to be 5,80,800. 5,80,800 upon EBIT, sandwich, remember that, 4,84,000, correct? So 5,80,000. So this is 5,80,800 divided by 4,84,000. So contribution, they have written it as 12,10,000 minus 629,200. This is nothing but what? 12,10,000 minus 629,200 is nothing but 5,80,800. Are you clear with this? Sales minus variable cost is only contribution. So you get operating leverage. These two figures you have, you get operating leverage is 1.2 times. What is your financial leverage? Financial leverage, I told you, yes. So when preference dividend is there, technically it has to be EBIT divided by EBIT minus interest minus your preference dividend upon 1 minus T, correct? So financial leverage will be EBIT on the numerator. EBIT is going to be how much? 4,84,000. So 4,84,000 divided by EBIT minus interest, that is nothing but EBT, correct? EBT, that is 4 lakhs. EBT, that is 4 lakhs minus preference dividend upon 1 minus T. How much is preference dividend? 50,000. So minus 50,000 divided by 1 minus 0.3. If you do this, you will get the answer as how much? 1.47 times. Are you clear with this? Just a matter of plugging the figures. The main thing here is about preparing this income statement using the data given in the question. Are you clear with this? Right? Now I told you, alternatively, even when preference dividend is available, sometimes institute is taking this formula, that is EBIT divided by EBIT minus interest, or in other words, EBIT upon EBT. Correct? So EBIT is how much? 4,84,000. How much is your EBT? That's going to be 4 lakhs. So if you use this formula, you will get a financial leverage of 1.21. Obviously, the answer will change. So, sir, financial leverage, is it 1.21 or is it 1.47? Look at this. That's why I've written out. For financial leverage, both the equations can be used in exams as per ICAI. Are you clear with this? So you can use any one of these two, or preferably if you want, you can, to play it safe, you can write both these formulas and put it there. Are you clear with this? So because here there is not much of a clarity at times, even when preference dividend is given, institute has ignored the preference dividend. Technically speaking, you should consider it. At times ignoring, and also they have done it. So anyways, let us not take the chance. You can write both the methods. It's just a matter of few more seconds. Are you clear with this? Yes. So with this, we have finished the first part of the question, that is operating financial leverage. Suppose in this question they had asked for combined leverage, what will you do? Operating leverage into financial leverage is your combined leverage. Are you clear with this? As simple as that. Next, cover for preference dividend and equity dividend. What is the meaning of this? Cover for preference dividend, this is called as, this comes in ratio analysis, this comes under something called as coverage ratio. Coverage ratio. Preference dividend coverage ratio, equity dividend coverage ratio. This is what they have asked in this particular question. So what is this, sir? I'll tell you. Now look at this. Preference dividend coverage ratio is profit after tax divided by preference dividend. Fine. You have the figures. Profit after tax, that is earnings after tax, is how much? It is going to be 2,80,000 divided by preference dividend is how much? 50,000. So 2,80,000 divided by 50, it's going to be 5.6 times. Very simple. Now, sir, for the preference dividend coverage ratio, why is the formula profit after tax, that is earnings after tax divided by preference share dividend? This is the question that you need to know. That is, this is the concept that you need to know. Very simple. What is the meaning of this? Preference dividend coverage ratio. Let us say you want to buy the preference shares of a particular company, right? Yes, they are saying that every year they will pay 10% dividend and all they are saying. But you want to know whether the company has the capacity to actually honor its commitment, correct or not? Just because they say they will pay, it is not necessary that they will have to pay, correct? What if they default? Yes, maybe then I will go to court. Yes, you will go to court, but you don't have time for all that. Yes, so basically when you want to invest in preference shares of company, the most important thing that you look for is whether the company actually has the capacity to pay my preference dividend, correct or not? Now you tell me, how much is the preference dividend? 50,000 rupees. Now preference dividend is paid out of what? It is paid out of earnings after tax, correct or not? See, out of earnings after tax only preference dividend is paid. That is before this I need to pay interest and my taxes and all, and out of the earnings after tax, this is the amount available out of which the preference dividend will be paid. So what we are doing is, we are actually finding out the coverage ratio, preference dividend coverage ratio. The formula is earnings after tax divided by preference dividend. That is 2,80,000 divided by 50,000. How much is it coming out to? It is coming out to 5.6 times. What is the meaning of this? The meaning is the earnings after tax, that is the profit out of which I am going to be paid my preference dividend, is 5.6 times the preference dividend amount, which means what? It is more. They have a lot of coverage, so I will definitely get my amount. This is the meaning. More the coverage ratio, better it is. Better it is for the company, better it is for the shareholder also. Are you clear with this? So I am calculating this EAT, that is the earnings after tax, upon preference dividend. Why are we doing this? We are trying to find out this earnings after tax is how many times the preference dividend. In this case, we saw that it was 5.6 times, which means what? The company definitely has, the company is earning 5.6 times the dividend amount they will pay, they will have to pay, so they can easily honor that commitment. This is the meaning of coverage ratio. Are you clear with this? Sir, then cover for equity dividend, or in other words, equity dividend coverage ratio. What is the formula? Very simple. Very simple. Now look at this here. Now earnings, your your equity shareholders, correct? So equity shareholders will be paid out of which amount? from their earnings for equity, correct or not? If at all the company has to pay dividend, they will pay it only out of this 2,30,000 to the equity shareholders. I'm not talking about preference, I'm talking about equity shareholders, correct or not? So if you want to further extend this, you will say earnings for equity minus your equity dividend, balance whatever you have is your retained earnings, correct or not? That's how it is going to be. Yes, guys. Yes. So now out of this earnings for equity only, the dividend will be paid to the equity shareholders. So now what is the dividend amount payable to the equity shareholders? So to the equity shareholders, what is the dividend amount? Now, have they given anything in this question? Yes. Equity dividend paid is 15%. 15% on the equity value, 8 lakh. So 8 lakhs into 0.15. How much is your equity dividend? The equity dividend is going to be 1,20,000. Are you clear with this? And this equity dividend will be paid out of what? Earnings for equity, that is 2,30,000. So we are trying to calculate the coverage ratio for the particular equity dividend. So for equity dividend, what will be the coverage ratio formula? The profit out of which I am paying equity dividend divided by equity dividend. The profit out of which I am paying equity dividend is nothing but earnings for equity, or in other words, you can say earnings after tax minus preference dividend, that is 2,30,000. Correct? That is what they have also mentioned here. PAT or EAT minus preference dividend, 2,30,000 divided by what? Divided by 1,20,000, 1.92 times. Or in other words, what it means is, yes, the company has earned 1.92 times the amount of dividend that is payable to the equity shareholders. So will they be in a position to honor the commitment? Yes, they can also pay the dividend, and even after that they will be having some excess amount. This is the meaning of coverage ratios. Are you clear with this? Guys, please learn the subject logically. You need not mug up anything. Are you clear with this? This is what they have mentioned here. Next, what is the next one they have asked? Earnings yield ratio and price earnings ratio. First, let us see price earnings ratio. What do you mean by price earnings ratio? Popularly known as P ratio. Price ratio is nothing but price divided by earnings for equity share. Or in other words, price stands for what? Market price per share. Earnings stands for what? Earnings price per share. Are you clear with this? MPS divided by EPS. Are you clear with this? Now, in this case, MPS is how much? 23 rupees. Yes. What is the EPS? What is the EPS? Can you find out the EPS? Yes. The earnings for equity is how much? 2,30,000. Correct or not? Yes. So EPS, can I say, is nothing but 2,30,000. This is the earnings available to the equity shareholders divided by how much is the number of equity shares? 8 lakhs divided by 10. That's going to be 80,000. Correct? Divided by 80,000. So what is your EPS going to be? So 2,30,000 divided by 80,000. It's going to be how much? 2.875. Are you clear with this? So 2.875 is going to be your EPS. Yes. So look at this. Your price earnings ratio is going to be 23 divided by 2.875. Price earnings ratio, as the name suggests, price divided by earnings, that is MPS, market price per share, divided by EPS, earnings price per share. So MPS divided by EPS, 23 divided by 2.875, it is 8 times. What is the meaning of this? It means that if the price, earnings price per share, the earnings per share is 2.875, generally the market price is 8 times your earnings. So the meaning of this, the price earnings ratio is, so in this case, it means that, let's say my EPS is 10 rupees, then it means my market price of the share is going to be 80 rupees. So generally, my market price is 8 times the earnings per share. Are you clear with this? This is the meaning of EPS in this case. Sorry, this is the meaning of price earnings ratio. In this case, it is 8 times. It can be any number of times. This is basically a multiplier. That is, it expresses a relationship between the market price and the earnings per share. Are you clear with this? Market price per share and the earnings per share. Are you clear with this? This is called as price earnings ratio. Some people even call it as price earnings multiple. Now, what do you mean by earnings yield ratio? It is the inverse of price earnings ratio. Here it is nothing but EPS divided by MPS into 100. Are you clear with this? This is nothing but it is the ulta of price earnings ratio. So earnings per share divided by market price per share into 100. So 2.875 divided by 23 into 100, that gives you 12.5%, or in other words, you are expressing your earnings as a percentage of your market price. So generally my earnings is 12.5% of the market price. This is the meaning. So this is earnings expressed as a percentage of the market price, whereas this is a multiplier of the market price in terms of your earnings per share. Are you clear with this? That's about it. Nothing great here. Next, finally, what have they asked? Yes, the net fund flow they have asked. Now, guys, you tell me, earnings after tax, how much does the company have? 2,80,000. Now, you tell me, out of this 2,80,000, not all the expenses are cash expenses, correct? So ideally speaking, this fixed cost of 96,800 is a depreciation. So net fund flow means what? Fine, all these things are fine. So what is the amount of cash that you have, the profit that is realized in cash? How much is it? Very simple. Just see, it is logical. You can just answer this logically. Look at this: net profit after tax, correct, plus depreciation minus the total dividend. Or in other words, they are starting from here. Profit after tax is how much? 2,80,000. Now this 2,80,000 is arrived after deducting this 96,800. So add it back, plus 96,800. Yes, minus all the dividends that you have paid. You have paid two dividends, that is preference dividend and equity dividend. So here preference dividend is 50,000, equity dividend we saw is 1,20,000, correct? So basically your earnings after tax, add back the depreciation which has already been reduced, fine, so add it back, and now minus the dividend. Why dividend should be subtracted? Because till now we have not subtracted. The base from which we have started is only profit after tax. So the dividends will have to be now subtracted, and finally you get this answer as 2,06,800, or this is nothing but the profit that is realized in cash. Are you clear with this? That is called as net fund flow. Are you clear with it? Net funds flow. Are you clear with this? So this is a cash realized profit. That is the meaning of this 2,06,800. And with this, we have finished this entire question, just question number 1. Are you clear with this? So now let's move to the next question. So the next question, question number 2. So let's read the question. A firm has sales of 75 lakhs, variable cost of 25 lakhs, fixed cost of 6 lakhs. So fixed cost is 66 lakhs they have given, which means what? This is going to be, if nothing is mentioned, you should assume fixed cost as fixed operating cost. Don't say that the total fixed cost, that is fixed operating cost plus fixed financial cost is 6 lakhs. No. If they have just mentioned as fixed cost, assume it to be fixed operating cost. Are you clear with this? 6 lakhs. Then it has a debt of 45 lakhs at 9%, that is the debentures interest rate is 9%, and the equity has a value of 55 lakhs. Now they've asked a few questions. What is the firm's ROI or ROCE? ROI stands for return on investment. ROCE stands for return on capital employed. Both are same. Does it have favorable financial leverage? If the firm belongs to an industry whose asset turnover is 3, does it have high or low asset leverage? What are the operating financial combined leverages of the firm? If the sales drop to 50 lakhs, what will be the new EBIT, and at what sales level the EBT of the firm will be equal to 0? 6 subdivisions they have asked. Maybe if they ask this, it could be a 10-mark question. Now, yes, this is also again the first part. Let us go one by one. The first part of the question, that is ROI calculation. It's basically your ratio analysis chapter, but anyways, it is logical. Let us crack that here. Now, before that, what we need to first do, remember always, in case of leverage chapters, the first thing that you need to do is what? You need to prepare that profit statement. So, profit statement, sales minus variable cost gives you contribution, minus fixed cost gives you what? EBIT, minus 9% interest gives you EBT. Correct? In this question, they have not asked, they have not given any tax rate. So, EBT is also equal to EAT in this question. Correct? There is no preference dividend here. So how do you know so there is no preference dividend? Because they have not raised any funds through preference only. So this is also my EFP. Are you clear with this? All bypass. This is like a bus route. All bypass. They have bypassed everything. Are you clear with this? Sir, how can we say this? Because no tax is there. So EBT is equal to EAT. Then no preference dividend is there. So EAT is equal to EFP. So everything is the same in this question. Are you clear with this? And all these data is given. There is no computation. This entire data is given in the question. So this interest is alone computable. So it's easy to compute. 9% on 45 lakhs. That gives you how much? 4,05,000. So overall, your EBT or EAT or EFP is going to be 22,95,000. Now you have the figures with this. Now let's get started. What is the firm's ROI? also known as return on capital employed. So return on investment, also known as return on capital employed. Very simple. Logically think, guys, just logically think. What do you mean by this? As the name suggests, it means return on investment, return divided by investment. Yes or no? Now, simple. In this company, what is the total amount that has been invested? 45 lakhs plus 55 lakhs. Correct or not? Yes. How much is that? That is going to be 100 lakhs. Correct? Now, how much has the company earned? How much the company has earned how much the company has earned, that is the earnings which is available for both these sources of finance. So what is the earnings that is available for both these sources of finance? Now, sir, what do you mean by this? Now, basically what I'm asking is, now you're saying this is returns upon investment, correct? Now, returns means what? How much the company has earned, that is earnings. So there are so many earnings. We have EBIT, correct? Then we have EBT, then we have EAT, then we have EFE. Sir, out of this, which one should I take in the numerator? You have this doubt, correct? Very simple. In the denominator, what we are taking? In the denominator, we are taking the total capital employed. That is the total investment from all the sources, correct? Debt, preference, equity, everything, correct? That is the investment. So in the numerator, logically, what you should have? You should have that earnings which is available for all the stakeholders of the company, all the investors. Now you tell me, what is the earnings that is available for all the stakeholders of the company? EBIT. Why? Because from EBIT only interest will be paid, and after that your tax will be paid, after that preference dividend, equity dividend. So the EBIT is the actual earnings out of which all the sources of finance will be funded, or all the sources of finance will be serviced. Are you clear with this? So obviously, return upon investment, in the denominator the investment is total capital employed, then in the numerator it has to be EBIT. Why EBIT? Because this is the earnings out of which I'm going to pay all the sources of finance. Are you clear with this? Yes. So what is the formula here? You have both the figures. So EBIT upon total investment. Total investment is nothing but debt plus equity. So if preference is given, that also needs to be added. Are you clear with this? That's going to be 27%. Now, what is the meaning of this? What is the meaning of this? That is, every rupee invested in this particular company is generating a return of 27%. Are you clear with this? Yes. Now, look at this. Very beautifully worded is the second part. Does it have a favorable financial leverage or not? They are asking whether this company is having a favorable financial leverage or not. EBIT is how much? 27%. That is, for every rupee invested in this company from whatever source of finance, the company is actually doing business by generating 27% of returns, correct? But actually seeing to the debt holders, you tell me leverage, why does it happen? Because of the presence of fixed financial costs. Now, in this case, the fixed financial cost is what? Debt channel, correct? Debt mode. This debentures, what is the rate of interest that I need to pay? 9% only. But the company is earning 27%, but they need to pay 9% only to the debenture holders. The balance, whatever it is, the equity shareholders can enjoy. Or in other words, this is the reason for the magnifying effect. Does this company have a favorable financial leverage? Yes, this company has a favorable financial leverage. Sir, how can you say that? Because your return on investment is greater than your cost of debt. Are you clear with this? Look at this. Since the return on investment is higher than the interest payable on debt, 9%, the firm has a favorable financial leverage. So always understand, in case they are asking for this type of questions, what you need to do. So favorable or unfavorable financial leverage, what and what you will compare? The return on investment should be compared with the cost of debt. Are you clear with this? Sir, in this question, they have compared it with the interest payable. Tax is not given. Suppose tax is given, what you need to do? You need to calculate the post-tax cost of debt, that is KD. So compare your return on investment with KD and arrive at the conclusion. Are you clear with this, guys? Is everyone able to understand this? Yes. Next, what have they given here? Now, if the firm belongs to an industry whose asset turnover is 3, does it have a high or low asset leverage? Asset leverage means asset turnover. So what do you mean by asset turnover? Asset turnover ratio. What is it? Turnover means what? Total sales, correct? So asset is total assets. The formula is total sales, that is net sales divided by total assets. Are you clear with this? Now, in this case, total assets is not given. So you can take, when total assets is not given, total assets means what? Fixed assets plus current assets. In case the total assets is not given, take this as equal to the total investment. As simple as that. Are you clear with this? So now, what is the total investment? 100 lakhs. What is the total sales? 75 lakhs. Now, what is this? The entire asset turnover ratio is how much? 0.75. It is expressed in times, 0.75 times. What is the meaning of this? Basically, they are saying for every 1 rupee, invested in this company, for every 1 rupee of asset put in this company, the company is able to generate how much? 0.75 rupees worth of sale. For every 1 rupee of asset deployed in the company is able to generate a sale of 75 paise. But actually seeing what is the industry average for every rupee of asset invested, the industry average is what? They are able to generate 3 rupees of turnover. But our company is not at all efficient. For every rupee of asset that has been actually invested in the company, deployed in the company is generating a sale of only 75 paise. So now you tell me, does this company have a high or a low asset leverage or high or low asset turnover ratio? Obviously, the company has a low asset turnover ratio. What it means? The company is inefficient, basically. Are you clear with this? Yes. So now, see, look at this. This is a favorable financial leverage. From a leverage perspective, it is favorable. From an efficiency perspective, there is still a scope of improvement. This is the meaning of that, right? So look at this. So asset turnover ratio is 0.75 times. The industry average is 3, hence the firm has a low asset leverage. Are you clear with this? Very, very simple. Next. What are the operating, financial, and combined leverages of the firm? Very simple. So in this case, there is no preference dividend, so there is no confusion. Operating leverage, contribution divided by EBIT. Then financial leverage, EBIT divided by EBT. And your combined leverage, multiply the two, or you can write it down as contribution divided by EBT. As simple as that. Look at this. Contribution divided by EBIT. There is your operating leverage. 33 lakhs divided by 27 lakhs. It's 1.222222. Correct? So there is a magnifying effect. Yes. Why is there a magnifying effect? Because operating leverage, magnifying effect happens because of the fixed operating cost. Then financial leverage, EBIT divided by EBT. The figures are already there. You can just put it. So what is it? This is happening because of what? This is happening because of the presence of the debt interest. Are you clear with this? And combined leverage is contribution divided by EBT. The combined leverage is going to be 1.438. We have all these figures on the top. It's just a matter of plugging the figures and doing it. Are you clear with this? That is a direct answer. Are you clear with this? Or combined leverage can also be done as operating leverage into financial leverage. You get the same thing. Are you clear with this? Now, the last two parts of the question are very, very interesting. This is where we need to, you need to understand this. This is very, very important parts because these two are the core of leverage. Now, look at this. If the sales drop to 50 lakhs, what will be the new EBIT? Now, carefully listen. What have they asked? If my sales drop or reduce to 50 lakh rupees, then what will be the new EBIT? There are two ways of calculating this. What you can do, you can once again, for 50 lakhs, you can once again prepare this income statement. Correct? How can you prepare? So variable costs currently 42 lakhs for 75 lakhs, which means you can arrive at VC ratio. You will have PV ratio. With that for 50 lakhs of sales, you can arrive at all the entire income statement. You can prepare and arrive at the EBIT. Fine. Now, there is one more way to do this. What is the way to do this, sir? Now, you look at this. What have they asked for? Look at this. What have they asked for here? If my sales drop to 50%, what will be the new EBIT? Now imagine this income statement. Now, whatever I taught you in operating leverage talks about what? The relationship between the sales and EBIT, correct? Or in other words, can we say operating leverage is equal to percentage change in EBIT upon percentage change in sales, correct or not? Yes. Now, you tell me, do we have the operating leverage with us? Yes, operating leverage is 1.22222. Yes, operating leverage is 1.2222 is equal to percentage change in EBIT that we don't know, we need to compute. Percentage change in EBIT divided by percentage change in sales. Now, what is the percentage change in sales? From 75, it is being reduced to 50. Or in other words, sales is dropping by how much? 25%. Correct? Sorry, sales is dropping by how much? 25 lakhs. Correct or not? Yes, so 25 lakhs upon the base 75. How much is this? 25 upon 75. Can we say this is nothing but minus 33.33%? The sales is reducing by 33.3333 percentage, 33.3333 percentage. Correct or not? Or in other words, can we now calculate what is the percentage change in EBIT? This cross multiply this. So percentage change in EBIT will be how much? The percentage change in EBIT will be 1.222222. It goes on into minus 33.333333 percentage. So how much is this? 0.333333. Retain the entire decimals into 1.222222. Keep all the decimals. So it's going to be how much? The percentage change in EBIT is going to be so 40.740 and it just goes on percentage. Are you clear with this? This is going to be the change in your EBIT. So if your sales fall by 33.33 percentage, your EBIT will fall by how much? 40.740 percentage. Are you clear with this? Now what is the present EBIT? 27 lakhs, correct? So 27 lakhs is the present EBIT, correct? So what will be the reduction in EBIT? 0.407407 into 27 lakhs, correct? Into 27 lakhs. So how much is that going to be? That's going to be what? So that is going to be, one second. Yes, so that's going to be 11 lakhs. Yes, that's going to be 11 lakhs exactly. That's going to be 11 lakhs. So how much you get? The balance is going to be 16 lakhs. So the revised EBIT is going to be 16 lakhs. Basically, the present EBIT is 27 lakhs. The fall, change in EBIT, how did we get this 11 lakhs? 40.74 percentage approximately into what? 27 lakhs. This is the fall in your EBIT. So original EBIT minus the change in EBIT gives you the revised EBIT. So revised EBIT will be how much? 16 lakh rupees. Are you clear with this? Use the concept of leverage to crack this question. Look at this. This is what they have done. It is going to be 16 lakhs. If the sales drop to 50 lakhs from 75 lakhs, it falls by 33.33 percentage. How did you get 33.33? So the difference between this is 25 lakhs. 25 lakhs divided by the base 75 lakhs is 33.33. Hence, the EBIT will drop by 40.73 percentage. They have rounded off. I have not rounded off. That's why I got the perfect answer of 16 lakhs. Since they have rounded off here, they got 60 lakh and 290. Are you clear with this? And then further, they just said it is going to be 16 lakhs. But yes, this is the way you can do it. Are you clear with this? So percentage fall in sales into operating leverage, and you will arrive at this answer. That is what they have mentioned here also. Are you clear with this, guys? Very, very simple. Now, finally, at what sales level the EBT of the firm will be equal to 0? The EBT of the firm will be equal to 0. At what sales level the EBT, earnings before tax, of the firm will be equal to 0? This is the question they have asked here. Now, what is the format? What is the format of your income statement here? So it's sales minus variable cost gives you contribution, minus fixed cost gives you EBIT, minus interest gives you EBT, minus tax gives you EAT, minus preference dividend, if any, gives you what? Earnings for equity. Correct? Yes, divided by number of equity shares, you get what? You get your EPS. This is what you get. Correct? Now, what they are saying, now they are saying at what sales level the EBT of the company will be equal to 0. Now, you tell me, when the EBT is 0, obviously the tax will be 0. Correct? Why? No earnings, no tax. Obviously, tax is a percentage on EBT. So earnings after tax will be 0. In this question, there is no preference dividend. So basically, your EFE will be 0. Correct? Your equity shares can be anything. Fine. Let's say 10,000 or whatever it is. Fine. So basically, your EPS will be 0. Are you clear with this? Or in other words, if your EBT becomes 0, it basically means your EPS becomes 0. Are you clear with this? If your EBT becomes 0, your EPS becomes 0 in this case. Correct? Sir, can EPS be negative? Yes. If there is a preference dividend needs to be paid even when you don't have your sufficient earnings. Correct? In that case, yes, EPS can become negative also, but we are not talking about this. In this question, there is no preference dividend. So basically, when your EBT becomes 0, there's nothing but your EPS becomes 0. Yes or no? Now look at this. Now can I say, what have they asked? At what sales level of the firm will the EBT be equal to 0? This is what they have asked. At what sales level the EBT be equal to 0? Currently, EBT is how much? 22,95,000, right? Accordingly, you would have computed the EPS. Now, you tell me a fall in EBT, the percentage change in EBT is same as the percentage change in EPS, correct or not? In this case, yes, because there is no preference dividend. In between only if you have a fixed financial cost, the leverage effect will be there, the magnifying effect will be there. If not, it will exactly be equal to 1. The leverage will be equal to 1, correct or not? So in this case, can I say the change in EBIT is the change in EBT is equal to the change in EPS? Yes or no? Yes. And what have they asked? What is the sales level at which my EBT will be equal to 0? Are you clear with this? Now, between sales and EPS, what is the relationship between sales and EPS? That is basically your combined leverage. So what is the combined leverage formula? Percentage change in EPS divided by percentage change in sales. Correct or not? Now, in this question, the percentage change in EPS and the percentage change in EBT are the same. Why? Because there is no preference dividend in between. Correct? So, can I rewrite this? In this question, can I rewrite this as combined leverage is equal to percentage change in EBT divided by percentage change in sales? Yes, guys. Are you clear with this? Now, what they are saying, do we have the combined leverage? Do we have the combined leverage with us? Yes, we do have the combined leverage. How much is combined leverage? 1.438, correct? So can I say 1.438 is equal to percentage change in EBT? What is the percentage change in EBT? Minus 100%. Sir, how do you know minus 100%, sir? Currently, EBT is how much? 22,95,000. They are saying at what sales level the EBT will be equal to 0. So if I want my EBT to be equal to 0, it has to reduce by the entire 22,95,000, or in other words, the change will be minus 100%, correct? So minus 100% divided by percentage change in sales. Are you clear with this? Are you able to understand this equation? With this, if you cross multiply, you can arrive at the percentage change in sales. The percentage change in sales is equal to minus 100% divided by 1.438. So tell me, how much is this? Minus 100 divided by 1.438. That gives you how much? It gives you minus 69.5410% approximately. Are you clear with this? Are you clear with this? So now what will be the sales level, the revised sales level? So this is what they have given. Are you clear with this? So this is going to be 69.54%, correct? 69.54%. So the revised sales level will be how much? So the revised sales level will be original sales minus 69.54% of that, or in other words, can we say original sales is 75 lakhs. So the revised sale will be 75 lakhs into 1 minus 0.6954, correct or not? Yes, so you will get the revised sales as 22,84,500. What is this revised sale? This is the sales required to make your EPS 0. So when it makes your EPS 0, obviously your EBT will be 0 in this case. Are you clear with this? Using the leverage formula, we have actually calculated the required change. Or if you want, you can do the reverse working. You can prepare the statement, do the reverse working, and also arrive at the answer. That way is also fine. That is easy method. But I mean, that is easy, but it's time consuming. Whereas this is actually more strategic. But if you're doing it in exam, it will take lesser time. Are you clear with this? So this way you can do it and you can arrive at the answer. So with this, we have finished this entire chapter. So please revise this entire chapter thoroughly. Fine. And now we will move to the next one.